Hello guys, welcome back to a new episode. In today's lesson, we want to look at how to combine smart money concept with liquidity to take high probability entries in the market. First of all, I want you to understand that the market moves primarily because of liquidity. The market does not move because of any other thing. It moves simply because of liquidity in the market. Once the smart money grabs liquidity, they move. I want you to understand that. So liquidity is actually the fuel of the market. So the question you need to ask is, what then is liquidity? Well, simply put, liquidity is floating money in the market. When I mean floating money, is the stop losses of retail traders. It also refers to the pending orders of retail traders. It could be buy or sell pending orders. All that the market makers are hunting for in the market is, where is the money? Now, you as a retail trader out there, you must also develop the smart money mentality. What I mean by smart money mentality is that you too needs to begin to look at your chart and then figure out where liquidity could reside in the market. Where do you think the retail traders will place their pending order? Where do you think they will place their stop losses? That will put you on the right side of the market alongside the liquidity providers. Okay, so I'm going to run through lists of types of liquidity that we have in the market. We have different types of liquidity. Number one, we have trendline liquidity. Two, we have equal highs, equal lows liquidity. Some people call it double top, double bottom, or triple top, triple bottom. The third type of liquidity that we have in the market are the old highs and old lows liquidity. The fourth type of liquidity is what is known as the inducement. Inducement is a form of liquidity in the market. Okay, the list I have given to you is not exhaustive, but these are the types of liquidity that occur frequently in the market, and you need to know about them and how to use them to your advantage. So with that being said, look at the schematic diagrams on the chart. First of all, let's look at the one on my left hand side now. See, take a look. This is an uptrend. There's no doubt about it. Now, you need to understand, when you're talking about SMC, how to mark your structures as SMC trader. True SMC trader, that is. Okay? And therefore, with that in mind, look at this. This high. Will you say it's a valid high? Certainly no. Because your valid high or valid low must take inducement before it's confirmed as a high or low. So this did not take any inducement, so it's not a valid high. This one also is not a valid high. This is not a valid high. Now take a look at this. Is this a valid high or not? Well, think about it. Look, this is not a valid high, but how about this? This becomes your valid high because it has taken out this inducement here. This is what is known as inducement, guys. So once inducement is taken out, your high is confirmed, and meaning that this high is confirmed, and therefore your higher low cannot be confirmed just yet until price takes out this major structure high and close above it, and that will become your break of structure. Okay, so that's your boss, and then this low will now be confirmed as your higher low. I'm talking about SMC now. So this is your major structure low, and price pushed up to form this high. This is not a valid high. It came down. Now, is this high a valid high? This high can only be a valid high if it takes out inducement. And where is the inducement here? Right here is the inducement. So if price comes down to take it out, this high will become your valid high. And therefore, let's assume price comes down to take it out. As you can see, it took it out. So it took out this inducement here to confirm this high. So let's confirm that first of all. So your high is now confirmed. So after confirmation of your high, now where is your trading range? Going by SMC, this is your trading range, guys. This is your range low here, and here becomes your range high. This one is your range high. Simple. Okay, so in SMC, we teach people to trade from range to range, and therefore this is your trading range, and therefore you want to take trade within this trading range. But something happened here. Take a look at what has happened here. When you mark your structure sliders using SMC, now check, is there anywhere here where you can have liquidity? Now, for example, like Trendline liquidity, look at this. Look at this. Okay, what do you call that? Take a look at this. I want you to understand something here. Let me show you. Look at this. Number one touch here, second touch here. All right, and therefore when price is coming back down, the retail trader has been taught that you take price somewhere here, because this is your trading range, so you are looking to take price somewhere here. Okay, but you realize that this will not happen. This is not going to happen. Why? Price will come down, okay, like this, tap on this your zone, and sometimes may give you a little reaction such as this, as if it's going back higher, and then all of a sudden, boom, it will come down. Why is that happening? Ask yourself that question. Why it is happening is because right here where you said this is your trading range, this range high, range low, and then you find your area of interest here, okay, which is your extreme area of interest, and you are told that this is high probability area of interest because it's the extreme. Now, why did price take you out, and where is price going? Now let me tell you why price took out this your zone. The first reason is this trend line liquidity. Any area of interest or POI that is sitting on liquidity will fail, and because this area of interest mark here is sitting on this trend line liquidity, look at first touch, second touch, so it is bound to fail. Price will have to take out all the liquidity resting below here, and then tap on an area of interest just below here. All right, once price taps on that area of interest just below there, then it can begin to move higher again. Please take note of what I'm telling you now. It can move higher to come and take out this high and continue with the uptrend. Do you understand what I'm trying to say? Please watch this video again and again. This is very important for you if you actually want to remain consistently profitable in the market. Now, I'm going to show you an example on the chart where I discuss with my student in my VIP community about this pair. We are looking at Euro USD here, so I'm going to show you, and perhaps will also help that my student to understand why price reacted the way it reacted. Okay, so please take note. The same thing in a bearish structure. If it were in the bearish structure, this scenario will play out. All you need is to invert it, and it will mean the same thing. Like in the bearish structure also, you have this trend line liquidity. Very, very important for you to understand this trend line liquidity. Okay, price will have to take out all this trend line liquidity before tapping into any area of interest and start going short again. So you have the first touch right here, you have second touch right here, and then you have the third touch right here. Okay, so when price is going back, price will have to do something like this to take out all this liquidity here. It has to continue to go higher to take out the liquidity there. Okay, Once it takes out all the liquidity, then it can tap on a zone here. Okay, let me use this to so it can tap on a zone there before price will continue in its downward movement like this, before price will continue to come down like this to come and break this low. Please take note of what I'm showing to you now, because this is very, very crucial. I'm going to take you to the live chart and show you example of what I have just discussed with you now. But that is the first type of liquidity. After this, I'm going to show you the second type of liquidity, but let me show you example of this trendline liquidity first, how it played out right on the chart. Now take a look at this. Please watch it carefully. Watch it carefully. Now this is your structure in the market. This is your low and this is your high, and this is your lower low. Okay, so price for this low to be confirmed, it needs inducement. So it took out this inducement here to confirm this low, and price continued to go higher after taking out inducement. Now normally, if we didn't have the opportunity of this hindsight, what we should have done would be after inducement, because we are bearish. Okay, we are bearish. So if we are bearish here, I'm not talking about on the right hand side here, I'm talking about on this left hand side, we are pretty much bearish. Okay, so if we are bearish and after taking out inducement to confirm this low, you should have marked your area of interest. And where will be your area of interest? Right here. To go short, that will be your area of interest. And as you can see, price came, tapped into that area of interest and reacted. It gives us a momentary reaction, but our expectational order flow would have been for price to come and break this low here. All right, but it didn't do so. This failed and price started going higher. I'm just telling you what expectation would have been if we didn't have opportunity of this hindsight. Okay, now so after that, remember, this is our chalk. It's the last lower high before this lower low. So when price went up, it took out this major structure high and closed above it, and that is known as chalk. After change of character, price took out inducement here to confirm this high. I want you to understand that, to confirm this high. Okay, so after the confirmation of that high, we are waiting for our higher low to come and sponsor the move to take out this major structure high here, and price has to close above it, and that will become your chalk, your break of structure in this case. Okay, so that will be your 4H boss. Now after taking out that this major structure high, your low is confirmed, isn't it? So this is your major structure low, and price traveled back up and printed this high. For this high, it needs inducement. Inducement is here. It didn't come to take it out, and then it pulled back and went back higher to take out this high. So this is our major structure high now. Why? Because it took out inducement here. Simple. So now where is our trading range? This is our range high. This is our range high. This is our range low here. All right, so range high, range low, meaning that this is where we are supposed to take our trade from. And so where is our area of interest here? Because this is our trading range, range high, range low, range high. Okay, so we are supposed to take trades within our trading range after inducement. So after inducement, this is supposed to be our area of interest. If this is too large for you, you can refine it anyhow you want it. Okay, so that's our area of interest. Now look at what price did. Price came, boom, took out that area of interest. Why? Because if you look at this carefully, let's look at this from this angle, from this. Okay, that's trend line. Okay, look at it carefully. Let me zoom in. Let me take out this one here for you to understand. Okay, so you can see this is first touch, second touch. Okay, that's trend line. Now, despite the fact that this is our trading range low, range high, but look at this trend line. Liquidity rests below this trend line. There is liquidity here, there is liquidity here. Until price comes to take out this liquidity resting here, okay, there is not going to be any reversal. Price will continue to drop to where? Now you need to look for your high probability zone after this trend line liquidity. And where is that high probability zone? Well, if you mark this one is already mitigated. This zone here, as you can see, is already mitigated, so we cannot use that one. So therefore, you will now have to look for a valid area of interest. Now remember, if you mark this as your valid area of interest, this larger one is already mitigated, so we cannot use that. So which one can we use now? Now you need to use this last sell momentum, this last sell candle before this buy. That becomes our area of interest in the market. And as you can see, price tapped into it and then move up to where? To come and take out the structure high here. Let's see whether it took it out. As you can see, it took it out clearly. Okay, so that is a simple way for you to use the trend line to take your trade in the market. I hope you understand. Please watch this video again and again. This is about trend line. The same thing with equal highs, equal lows. Now let's get back to the whiteboard and let me show you what I mean by equal highs and equal lows. Okay, let me use this space here to tell you about that. What I mean by equal highs and equal lows is, for example, price is doing something like this. So this is your range here. Look at your range here. Okay, price is trapped in this range, equal highs, equal lows. Now once you find this kind of thing in the market, and now you have an area of interest, maybe somewhere here, maybe somewhere here. Okay, because of, no, sorry, maybe you have an area of interest somewhere here. You have an area of interest just somewhere here. Please bear with me, my connection is terribly bad today. So you have an area of interest somewhere here. Okay, now this area of interest is going to fail. Why? Because it's sitting on liquidity, it's sitting on this equal highs. So when price is coming back higher, price is bound to come and take it out before going back down. So you need to understand this liquidity concepts so well. You need to understand it so well. If you don't understand the liquidity concept so well, then you will always be on the wrong side of the market. I want you to understand that very well. Okay, I'm not going to go on and on and on, but that is about equal highs, equal lows. Now how about all highs and lows? The examples of that one is all over the place, all over the chart, all highs and all lows. Okay, for example, look at this. This is liquidity resting here. This old high will be taken out at some point in time. Okay, why is it known as old high? It is known as old high because when it printed this high, price pulled back and then went back again to take out that old high with a candle wick. Can you see that? So that's liquidity for you in the market. All right, and therefore because it has already taken liquidity there, then you can enter your trade after liquidity has been grabbed. Don't enter until liquidity has been taken in the market. That's the idea of this video. You don't need to enter the market before liquidity is taken. Let the smart money grab liquidity before you do anything. It's all over the place. You can see it all over the place on your chart. If you go through your chart, you will see equal highs, equal lows taken out. Okay? Taken out. You need to wait for that to happen before you take decisions in the market. You need to wait for it. Let's look at whether we can find any example here, so I can show that to you. Very, very important. Very, very important. Extremely important. Look at this. This is an example of relative equal highs and lows. I mean equal highs, relative equal highs. Look at this. Okay, so if you drag this out all the way, you find out that price has taken out that equal highs here. Look at it. High number one, it pulled back, went back, it couldn't break it, come back, and therefore the third time here, okay, on trend traders want to take their trade from here to go short, and that will not happen. So what will happen naturally is that they will push price up a bit to take out all the liquidity resting above this high. All of them will be taken out. Okay, and after taking it out, boom, price went down. Please watch this video again and again, and then you will get to understand what we're talking about here. If you have any questions, please let me know. It is the same thing here. Trendline liquidity is also in play here. Look at this. It's also trendline liquidity. Okay, took out number one, it took this out, first point, second point, third point. Okay, and boom, price came down to where? To tap into something here. If you go to lower time frame, maybe your area of interest somewhere here. Okay, you'll find your area of interest somewhere there, and therefore price came into that area of interest before going higher. All right, it came into the area of interest and then move a bit higher. I hope you understand what we're talking about now. So that is how far we can go. But if you are new to our channel, please endeavor to subscribe and turn on the notification so that anytime we publish a new video like this, you'll be notified about it. And if you haven't joined our free Telegram channel, please do so just immediately, and get yourself prepared, because God willing, by next week we are going to be starting our live stream. We either do it on Monday or Wednesday. We're going to hold it once a week. We are going to decide if it's going to hold on Monday or Wednesday. All right guys, thanks for watching.